Earlier today, I had a session with Kenneth. So we did the fixed income for the CFA series. So we're doing it in two different sessions because of time zone issues. So now we're doing a separate session with Andre, and we are covering mainly just real estate related topics. For the first few episodes, we will focus on the curriculum for the CFA. CFA, there's this alternatives investment, and there's a component, real estate is a component in the alternatives investment. So we'll just cover that first, and then eventually for this real estate series, we're going to cover everything that concerns real estate. So for this particular curriculum that we're following is the CFA Level II. So there's actually a Level 1 real estate, but it's basically just a simple version of what they cover in Level 2. So we just jump straight to Level 2. So earlier podcast that I did with Kenneth is starting off CFA Level 1. And then we will cover every topic that is in the CFA module. But for this podcast, it's only real estate related. So before I continue, Andre, you want to say something first, or shall I just stop?
Yeah, I think this topic of CFA on real estate, I think is very relevant to me because it's something which I'm always reading up about real estate information, because it's something which I find interested to go into real estate, and I'm also aware that there are many others out there who may be much better. So using this opportunity, talk about it, grow more in terms of what I need to know, and hopefully everyone out there can just in certain ways or at any time can just join us one day. All right.
I'm looking at this from the perspective of what I did in the CFA in that class. So even for me, I'm not any real estate expert myself, so I can only showcase from the especially from a financial perspective, right? Especially when it comes to valuation, and so it will be also a learning experience for me as well. And I'm also pretty sure that Andre has more real estate experience, and as an architect himself, I'm pretty sure he knows a lot more about buildings than me. So what I'm trying to say that it's a learning experience for all of us. So let's grow together as a journey that we take. But for the beginning, at least we will just cover strictly from a CFA curriculum perspective. Okay, without further ado, let's go on with the first slide. Today's podcast, we're going to cover private real estate investments. Real estate, you can separate it into equity versus debt, and also public versus private. 4 different categories, right? So in terms of private, we have private equity, private debt, and in terms of public, you have public equity and publicly traded debt. So I'll just quickly go through what's on the slide. So for private equity, we have this direct investment in real estate, including sole ownership, joint ventures, real estate limited partnerships, or the types of commingled funds. And for private debt, we have like mortgages. Okay, so before I continue on, do you want just based on reading this, what do you think it is like in terms of like private equity?
So basically, it's ownership of properties. That is, it could be in various way, whether it's with someone else, or it is through. I'm not too sure about all other types relating to funds, but for me, it's more of a individual ownership.
For most people that buy their own place, it can be considered a private equity because you are the sole ownership. So and then you borrow to buy the property, so you also have this the debt part, which is the mortgages. So this is like basically covers both equity and debt. Usually you will be borrowing money, that will be just purely debt, right? As you would pay off, then you would eventually own the real estate. But in terms of what they're trying to say here is that there are certain like private real estate funds, like corporations that own properties, be it commercial or residential. And if you were to buy the shares of this company, okay, because they are private, so you cannot actually buy the shares of this company. But if you are like one of the owner of the private limited partnership, so basically you own these properties, right? And basically it's like a equity in the sense that it's ownership with. But there are other funds that like you only strictly invest in the mortgages, right? Basically, you're just strictly lending money to these companies that are buying these properties. So you will not have any claims on the rentals. You have no claims in any capital appreciation. You're solely just lending money. You're just getting the interest payment. So imagine, like for example, a bank give out a mortgage, solely you're only getting the interest, right? It's nothing to do with appreciation or even the rental. And yeah, so it's similar to the earlier session I had with Kenneth in terms of fixed income. So it's like a bond, but in terms of the private, it could be more akin to a loan. We have shares in real estate operating companies, REOCs and REITs, right? And then publicly traded debt, which is mortgage-backed securities for both residential and commercial. So the big difference between public and private is that private is not open to the public, as in you cannot actually, like for example, if you want to buy a share into a certain private real estate company, like for example in Singapore context, it's the capital land. Public, there are two types, right? One is that you can buy directly the shares of the company. Another is through REIT, so a real estate investment trust. So it's actually a trust. So what they did is that they will hand over all the assets and put in the trust, right? So it has nothing to do with the company. In terms of the balance sheet, it's like separated. So anything that you get from the rental and everything is you'll just go directly to the shareholders. And I think in the US, if you pay out 90% of the rentals, the trust itself will not be taxed. So there's only tax on one side, which is the shareholder in terms of the income or the capital appreciation that you get from the REIT. And we will cover more in the later slide. But this is the publicly traded means that the people can actually buy the shares or the REIT shares directly from the brokerage account. Yep. And for mortgage-backed security, MBS this is the and you can also buy the loan as well. In terms of the private one, is the banks are the ones that are mostly lending out the loan, right? But for publicly traded, you can actually buy. During the 2008 financial crisis, there was this subprime crisis, right? Yeah, that is basically the mortgage-backed securities caused the whole US market to go down, including the global market during the 2008 financial. It's all because of the mortgage-backed securities. Private real estate investment typically involve larger investment due to the indivisibility and illiquidity of the real estate properties. So this is probably like those real estate companies that are private. They will just buy off these property, multiple assets, right, multiple properties, and this involves a lot of money, right? So for each shareholder of the private company, they probably will have to invest in terms of the equity a lot of money. And if it's open to the public, we can subdivide it into more smaller components and smaller shares. Is basically what it's trying to say here.
Just a simpler terms of the word illiquidity, that is, or liquidity, that just means that the ability to sell and buy.
Tricky part is trying to contrast it with the public part. Because okay, if like for example REIT, you can trade REIT, you can buy and sell REIT, right? During market trading hours. So it's liquid in the sense that you can always buy and sell anytime you want, right?
Okay.
But for private real estate investment, like, if you are like one of the shareholders, or you're one of the person that is like part of the company, you cannot just say, you're happy today you want to sell, right? Like, it's not publicly traded. I don't even know what is the price that you want to sell, like how much it's your shares, because it's not publicly traded. But for REIT, is publicly traded. That means there is an active market pricing whatever it is in the market right now. So you can actually know the price. But for private ones, you cannot know the price
But both
because
of
there's
them,
no active market.
but both of them, when like as part of a partnership, for example, if I choose to back out or I choose to join,
You cannot easily back out. That's the difference.
but are those decisions like for the private or even the public? Public probably more obvious, but are the decisions more directly related to the property themselves? Because it's not, right. It's just having a shares in the venture. That's all.
Yeah, but in the ventures, you cannot just back out anytime you want, right?
Because it will affect.
Yeah, because first of all, the amount is huge. And also because if there's an active market, people are constantly researching and eyeballing all these investments so they can have a price on it, right? But for all those that are not priced, because of the fact that you don't really know how much is the value. I feel you appraise the property, and this involves a lot of costs and time. But for publicly traded, like REIT or even shares of the company itself, it can be traded in the market. You can do it anytime during trading hours.
Right.
So that is the key difference, and this what this section is trying to say here.
Yep.
Yeah. And also, private equity investment in real estate properties demands property management expertise from the owner or hired property managers. But the thing is, I would think the publicly traded will also have that probably is already part of the actually, if it's real estate owned by this is a real estate companies, right? REOC is operating companies, yes, right? It's professionally managed and relieving incentive entities of the need for. Yeah, these are also professionally
Yeah.
managed, right?
Just that in a different focus. That's all. Like, yeah.
Yeah, actually, you don't have to worry about it. But if you're having your own private, okay,
Yeah,
maybe it's
you have to arrange for the management as well. Yeah.
exactly. For example, you and I, maybe we want to have our own partnership and we want to start buying properties, right? Just imagine we retire with a lot of money. Then we if it's a REIT, we don't have to worry about management, property management. But in
Yep.
terms of, we will have to have this our own, you have to hire and have to worry about that. And also, if you just apply that, allows for the division of ownership on or claim from properties, right? Without greater liquidity and the ability for investors to diversify across multiple properties. So, for example, if you and I were going to buy properties together, I mean, at most you can only buy one or two, right? And you have to put in a lot of money for each property, right? Like in the case if it's just the two of us, we each have to put 50%, right? But if we buy shares, the share is breaking up into so many thousand, many pieces. With the same money, we can probably diversify and buy a lot more different properties. That's in a sense what this is trying to say.
Yep.
Yeah. So real estate investment require management, whether through direct ownership or investment real estate operating. Yeah. So this is the part that I was trying to say. Both cases were require management. Okay, equity versus debt. Equity investors typically anticipate higher returns compared to debt investors due to assuming greater risk. So this is saying that in terms of if you are the bank issuing the loan, the mortgage loan, and also if it's a mortgage-backed securities, because all you get is the interest from the loan, right? So on average, you would think that the investor, the people that are actually investing in the property itself, eligible for the appreciation and also the loss, and also the rental income, they'll be eligible for it. But for debt investors, you don't have that. So you would expect typically that the equity investor will have a higher return. Is what this part is trying to say. Then for a debt investor's claim, it's only on the cash flows, and proceed must be satisfied before equity investors receive anything. Make equity investment riskier. So this is like a bond, something like a bond, right? So if there's anything that problematic, you have to sell the property before the equity can get anything from the property. You will pay off your debtors first, right? It's like if you were to default on your mortgage payment, the bank would liquidate your property, and you will pay the bank first, right? So if it's not enough, you still owe the bank money. And if it's more than that, you'll pay the bank first before you will get any. You will get the residual amount only after the bank is paid. So so it's just similar as bond. If a company were to
The difference between equity and debt is equity is more tangible, there where you're investing in properties, whereas debt, from my understanding, is not that tangible. It's more of shares.
No, debt is just lending money. You're just lending money. And when you lend money, you just get an interest, right? It's like a bond. Bond is a way for you to borrow money, right? You lend money, if you're the bond holders, they're lending money person. All you get is only the interest.
Yep.
Nothing else.
Oh, okay.
But if you're the equity, basically you own the property, right? The asset or the company. So anything that any money that you earn from the properties, you have a cut of it, right? Because you're the shareholder.
Yeah.
But for the debt investors, they don't have any claims on any other than just the interest. So for that, they have a higher seniority in the sense that they have a higher claim, right? But they have only fixed cash flow. That will be the interest rate.
Yeah.
But for equity, you have a lower claim, but usually it's riskier, but you stand to gain more if things work out well.
What is the type of situation I will be involved in either one? Like for example, equity, obviously buy property, isn't it? Whether in various means. How would I be involved in the real estate debt investor situation? Is there like is it just financial products?
Yes, that's a financial product. Okay, so to move on, equity real estate investors receive returns from rental income and property value appreciation. This is basically what I said just now, right? So if these returns are not perfectly correlated with stock and bond returns, adding equity real estate investment to a portfolio to offer diversification benefits. So you can think of it, we'll cover this in the later slide, but I just give you a heads up, like a rough idea. So you can think of real estate investment in terms of equity, somewhere in between of stock and bond. It's not perfectly correlated, which means that if the market does well in the stock market, the real estate might not do so well. So they are not really correlated. If both of them do well at the same time and you do badly at the same time, that means they are correlated. They move together. And if they move together exactly the same, then it doesn't have any diversification benefit if you own both of them, right? Versus just owning one of them.
Right.
So you want to do it in such a way that there's some kind of not perfectly correlated. But the truth of the matter is, during a financial crisis, everything is correlated, which means everything goes down together. As you know, during the 2008 financial crisis, right? The properties went down, mortgage-backed security went down, stock market went down. So the truth of the matter is, when you need diversification the most, is the time where it doesn't work, because everything goes down during a crisis.
Cool.
More on that in the future. Okay, so real estate debt investors. So this is the mortgage-backed securities, right, for the public part. Whether through private or public markets, expect returns from promised cash flows, which is from interest rate, without participating in property price value appreciation. So this resembles other fixed income investment like bonds.
Mm.
Yeah, this is exactly like bonds. But the difference is based on the amortizing part, which we will cover later.
I was just trying to understand the risk involved in both as well versus the gains.
The risk is higher for the equity,
for the
but the
equity.
gain is also high.
The risk is higher for equity is because you need a much larger amount of money.
Okay, I think my understanding is this, because I covered this with Kenneth earlier on as well, because it's very similar to bonds. Okay, you just imagine you buy a mortgage-backed securities, right? You get a fixed interest, right? Because you're lending money. So whether the property goes up or go down, whether you got any rental, tenants or whatever, you still get the same amount of interest, regardless what happens to the property, right? As long as the company,
portfolio,
person borrowing from you doesn't go bankrupt, doesn't go bust,
yeah.
you will get your money for sure, right?
Okay.
So that is the concept of debt, right?
Yeah.
But if you are equity owner of the property, like just imagine you own a residential property. If you don't have any tenant, no income comes in, right? Or the property drop or gain in price, you are liable for all these, right? It affects you directly.
Yeah.
But if for the banks, as long as you pay your mortgages, the bank doesn't really care. I mean, it does care in the sense that the counterparty risk, credit risk might go up. But to simplify things, just imagine it doesn't matter as long as they get their mortgages. It doesn't really make a difference, right? So in a sense, it's a lot safer if you are just lending money, which means that your potential return is also lower because you do not participate in any form of appreciation or rental income.
Right.
Yeah. So that's one way of understanding it.
Mm.
Okay. Characteristics and classifications. Real estate possesses unique characteristics that distinguish it from other major investment asset classes, complicating its measurement in evaluation of performance. Okay, this part, comes to a very important part. Heterogeneity and fixed location. Okay, so unlike standardized bonds and stocks, where each, like for example, talk about Apple shares, like each Apple share is the same, right? It's fungible. Like you don't really care. There is one share is the same as, the another share, right? There's like no